I'm delighted to celebrate this 100th anniversary of Milton Friedman's birthday. I've been asked to talk about his academic contributions, which have changed not just public policy, but also much of academic thinking. There are four I would emphasize before I briefly discuss the relevance of his ideas to current macro policy debates, both here and in the US. Now, his first great book was The Consumption Function. And in some ways, I think this is his greatest work. Keynes had argued in his general theory that households increase their consumption in a smaller proportion than their increase in current income. Now, this became the cornerstone of what used to be called the multiplier in Keynesian theory, whereby if you have an autonomous increase in expenditure, that leads to an even larger increase in aggregate demand and thence economic expansion. Now, this argument, those of you who follow Krugman and various other people, has of course been resurrected in the current Great Recession. But the evidence, which even many Keynesians had to accept, was that the data from what are called contemporaneous cross-section data, that you take households across at a particular point in time, and then if you look at historical household behavior based on time series data over time, then these are both inconsistent with the Keynesian consumption function. Now, Friedman showed that this Keynesian concept of household behavior was fatally flawed. People base their consumption on variations in their long-term expected, or what he called permanent income, and not on these transitory variations which can go up and down depending upon shocks and various other things. Thus, on the permanent income hypothesis, the relative low propensities to consume, which people found from the cross-section data, were consistent with the higher propensities to consume, which you found in the time series data. Now, the importance of this permanent income theory is, I think, accepted very widely and is incorporated in almost every aspect of applied economics that I can think of. Now, the second major contribution I would emphasize is Milton's. He's one of the earliest people to make a case for floating exchange rates. Now, this, of course, is another issue with considerable contemporary relevance, given the ongoing crisis in the fixed exchange rate Eurozone. Milton's case for flexible exchange rates was largely based on his view that a country needed the freedom to choose its own monetary policy without being concerned about the balance of payments. Now, more recent theories about the adjustment mechanism base them not just on this, but on recognizing the importance of the real exchange rate, that is the price of traded to non-traded goods. And the real exchange rate, which changes all the time, this, under a fixed exchange rate system, to get the necessary adjustment of the real exchange rate, it requires that all domestic prices and wages must change to get the necessary equilibrium. Whereas if you have a floating exchange rate, you just change one price, the nominal exchange rate, and all these exchanges and all these relative prices will be immediately fixed. So as we see in the current Eurozone crisis, the club-made countries are facing an internal devaluation to about 30 or 40% through deflation. And this would have been unnecessary if their own independently floating currencies were available to deal with their payments imbalances with various surplus countries in the Eurozone. The third major contribution of Milton was, I think, to his critique of the Phillips curve. Those of you old enough remember there was a huge argument going in the 60s and 70s about the trade-off between inflation and employment. In his presidential address to the American Economic Association in 1968, he questioned this view And in a sense, though he doesn't mention it in that paper, he was taking off from a question asked by Wicksell, and which in my view is central to all the various macroeconomic perspectives which have been offered since. Wicksell asked, and this is based on the fact that in fact by the late 19th century the gold reserves, which were the base for the pounds, had declined to a very small share of the value of the pound. And the question Wicksell asked, how could the price level be anchored in a pure credit economy? And his answer was, if the bank rate could be set at the natural rate of interest, which balances productivity and thrift, the price level could be kept constant. Now, Friedman used this. He argued that with the real natural rate being determined by productivity and thrift, monetary or fiscal expansion will only raise nominal interest rates through inflationary expectations. Given this natural rate, there will also be a natural rate of unemployment, which now is called a NAIRU, because natural rate of unemployment doesn't sound very nice. So non-accelerating rate of unemployment. Now, monetary expansionary policy can then only lead to transitory deviations from these natural rates, if assuming, of course, that capital and labor markets work relatively well. So there's no long-run Phillips curve. And I think most people now accept this. The most famous example being, was it Peter Jay, and then his father-in-law, James Callaghan, being convinced of this in the 1970s. Milton's fourth great contribution, and that of course is what people most remember him for, was his monumental study with Anna Schwartz, called A Monetary History of the United States. And in this he showed that the variations in the rate of growth of the money supply had short-run effects on real output, as in the Great Depression, and on prices, but in the long run, the only substantial effect was in prices. And this confirmed one of the assumptions of the quantity theory of money, that the long-run demand for money was stable. Following from this, he recommended his policy of maintaining a fixed rate of increase in the broad money supply. Now, there's been a constant and probably justified complaint that Friedman's view of the transmission mechanism, that means money leads to spending, or rises in money lead to rises in spending, this was never theoretically tied down. And so many people thought that Friedman's monetarism is a black box. But later papers by Karl Brunner and Alan Meltzer in the 60s and 70s, and above all, Alan Meltzer's recent magisterial 3-volume history of the US Fed, I think should put these doubts to rest. I now want to finish by asking the question, have Milton's prescriptions for monetary policy, how have they fared in this great recession? At his 90th birthday party, Ben Bernanke, the current chairman of the Fed, promised Milton that having read his and Schwartz's great book, he would never let a Great Depression occur again. Now, by and large, the Fed in 2008-9, the Bank of England and the ECB in 2009, through their policies of QE, have increased the broad money supply in their respective regions, and which, through what is called the real balance effect, has led to a stalling of the deflationary impulse generated by the global financial crisis. And this led to some economic expansion. But recently, all these economies have stalled, with the UK in a double-dip recession. Why? Now, Tim Congdon, the last remaining British monetarist, has put together data which I think provides an explanation. Unfortunately, both the US and the UK stopped publishing broad money figures, I think some years ago, so he has to construct all these. Now, if you look at his figures, the growth of broad money, M3 or M4 for the US, UK, and Eurozone, shows that after their periods of QE, Instead of following the Friedmanite prescription of maintaining a fixed rate of increase of broad money, in all three regions, there have been sharp changes in the trend of broad money. Not just that, there's been a crash to negative rates of growth since 2010. Now, given the lags involved in the effects of monetary policy or monetary policy outcomes, the current deflationary trends in these economies can be readily explained. But then finally, why, despite seemingly accepting the monetarist case, which these various periods of QE suggest, have the monetary authorities failed to keep broad money growing at a constant rate? This, unfortunately, is due to the rise of an academic theory, which many of my colleagues subscribe to, of the monetary transmission mechanism, which has been christened by Ben Bernanke, and he's written some papers on it, as creditism, or what is probably better called the bank lending theory, as Alan Meltzer calls it, to contrast it with traditional monetarism. This theory argues that the relevant channel for monetary policy transmission is the credit channel, that is bank lending to the private sector. But if you go back and look at Friedman and Schwartz, and more recently Alan Meltzer's work, they show that clearly, firstly, money and credit are different, and it is money that matters for the economy. Now, I think the simplest way to bring this out is a question I used to set for my Oxford undergraduate tutees in the mid-1960s. And I think it's a question actually Milton once posed. I remember him asking this. What would be the effects of a large helicopter drop of money in the UK? Now, the answer is that this increase in the cash holdings of all private economic agents in the economy would lead to a deviation of the composition of the asset portfolios from their previously desired ratios. So you'd have more cash relative to goods and other assets. Now, looking at the economy as closed, certainly the domestic economy, forget about foreign trade for the moment, this excess money could only be spent on goods and assets. Okay? And the cash ratio, the preferred cash ratio, which we assume was an equilibrium one initially, would only be restored in their portfolio balance once all the prices of all other goods and assets had changed. And that, of course, would also impact spending, and if you were not at full employment, national income too would rise. Now, this would happen irrespective of what was happening to bank lending. This is the creditors' lodestar for monetary easing, whether it was flat or falling. So its spending depends on money balances and not bank lending. Now, unlike the Fed chairman, who described his QE policy in 2008, not as quantitative easing, which is increasing the quantity of money, but as credit easing to lower credit spreads, Mervyn King, in the UK's brief reversion to monetarism in 2009, he used traditional open market operations to buy gilts from the non-bank public to increase bank deposits to boost the broad money supply. Now, this increase in deposits at banks, which is their liabilities, is entirely different from increases in bank lending, which are banks' assets. The former, that is increasing their liabilities, deposits rising, that requires no increase in their capital, as these liabilities can be readily offset by increasing riskless assets in their cash reserves at the central bank or purchases of government debt. By contrast, loans to the private sector, this is the assets, these are always risky and will require extra capital to cover any defaults. So this continuing theoretical confusion between money and credit, I would argue, is largely at this intellectual impasse, which you see in the newspapers, you see a lot of commentators making the same mistake, is really why the old Friedmanite rule that money, spending depends on money, and hence what you need to do is increase broad money, has not been followed. But there are two other dangerous tendencies of thinking in terms of credit rather than money. Now, the first is clearly evident in the US. To ease credit in the troubled housing market, the Fed, unlike the Bank of England, has conducted traditional open market operations to increase borrowed money. The Fed instead has purchased mortgage-based securities to reduce their interest rate. Now, this is equivalent to the monetary authorities undertaking credit allocation, which would not be permissible in a market economy. The second danger is that by embracing what is called financial repression, by keeping interest rates artificially low, most recently in its so-called Operation Twist, there's a bubble in treasuries, which, when it bursts, will lead to the euthanasia of the bondholders, much has happened in the decades after the Second World War. Now, perhaps the undisclosed intention of Bernanke is to mitigate the US's large and growing debt burden through this euthanasia. Thus, the failure of the world's pivotal central bank to accept that broad money and following the Friedmanite rule matters is likely to continue the title of Friedman's last book, Money Mischief. Thank you.